Hey Zach, so it's me again today, huh?
It's you again today. That's right.
Danny gets a little scared when he knows that I'm here unsupervised by him. Are you aware of that? I don't know why. Yep, there he is.
There's the man himself.
So he put Ted in charge of keeping me in line today. So
Yes.
Ted, are you ready for that?
I
Tall
am.
order.
I am. Yep.
Danny also says you look too young, Ted, and he's wondering if you could get a fake beard and mustache for next week's show.
I
Sounds like
could.
genuine
I'll look into
Danicrism. Yeah.
Okay. You know, it would be cool if it was blonde.
There you go.
it.
Platinum blonde, like
I'll
Thor.
do it. I'll look
Yeah.
for it.
All right.
Or what? Or white.
So I'm
White
I'm
would be cool too.
I'm supposed to make sure that I. Danny said I have to attribute this quote to him and work it into the show. So I'm going to get it out of the way right at the beginning. He says it's not enough to be a fiduciary. You have to be a fiduciary with a sell discipline, and with a sell discipline is capitalized with three exclamation points. Attribute that quote to me, Don Ho. He calls me Don Ho. Don Ho was a ukulele singer, Hawaiian ukulele singer from back in the 70s, I think.
Don Ho.
You ever heard of him, Zach? Don Ho?
I sure
Well,
haven't.
not
No.
okay. Well, now you've got your first picture for the podcast
I'm
video.
looking
Don
him up
Ho.
right now.
Okay. And I of course, call him little Danny Stewart, the big bad Texan. So, all right, let's move on. So let's go from my IT days. We talked about my IT days pre-show. We're gonna do an agenda because in IT, I was a stickler. Don't ever schedule a meeting without an agenda. People need to know what they need to be prepared for going into the show, and that's why I show the agenda before every uh, video that we do at night. So, are you ready? Here's our agenda.
Let's hear it.
First of all, I started this last night. I'm going to go into it a little bit more. We're going to feed the trolls, Zach.
Okay.
Did you know we've had trolls?
I did not know we have trolls.
You're going to learn a lot today, Zach.
Yeah.
Okay, number one, feed the trolls. Number two, Levee versus Bessemer Trust. Are you aware of that court case?
I don't
Zach?
even I'm sure not.
You are going to be aware of it by the end of the show. Number three, um, when you ask an advisor why and kind of an advisor with a fiduciary advisor without a sell discipline. When you ask them why they're holding something, and they say, "If you disagree, have at it." What do you think your reaction should be if you're a
Hmm.
client? Okay, well, we got a client who's now a Revere client, and they had at it. Okay, so
Oh, all right.
we're going to go over that today. And then, okay, number four was Danny quote. I got that out of the way. And then segments. Michael is going to do fertilizers, right, Michael?
Yes, sir.
Ooh.
Fertilizers. The charts looked a little bit better before today, but today is
Yeah.
following up on yesterday, where the market came and got not only the indexes but the leaders yesterday too. And then Ted is going to talk about something that we're looking at, something fairly new in house here. And we've mentioned it before, but we haven't taken a deep dive on it before. And that's going to be single stock inverse ETFs, which is a way to get the equivalent of short a stock in a retirement account. That's something that they do not allow right now. You can only take long positions, but we, for years, have been taking long positions in inverse ETFs if we wanted to either hedge or short the indexes or a particular sector. But now you can do it with individual stocks, and Ted's got a nice presentation on that. So let's get started.
Mm.
So are you ready,
Let's do it.
gentlemen? Okay. So last
Let's roll.
night in my video, I started off the video by saying I'd like to give a big middle finger to the people who think that they can use the contact us on our website to send anonymous troll comments to us. So let's talk a little bit about the trolls who think that they would better run Revere Asset Management than the way Danny and I run Revere Asset Management. Are you ready?
Let's do it.
So first of all, Zach, did you know we have a toxic work environment?
oh, this crew? I had no idea.
Yes.
No,
Toxic
okay.
look how scared Ted and Michael are right now from this toxic work environment. They know that I could just snap their heads off at any minute with my sardonic wit and insults.
That's right.
And so toxic. And I guess that the perception of that was because uh, three guys left in short order in the period of less than a year. Alex, there were some things he didn't like about the job. He went back to being a full-time trader, and he's still a consultant, still on us. So I guess if Alex hated us so bad, he's putting it behind him, and we still talk on the phone every day and cut up. So that's number one. And then Tim decided to start to pursue his dream of starting and continuing and growing his family business. And I guess he's not allowed to do that without the permission of the trolls, because two people leave, and that's a completely toxic work environment. And a super mega toxic work environment is when Hunter decided that because he didn't really particularly care for working at home and wanted to be in an office environment, and somebody presented him with a very lucrative opportunity, he was not allowed to take that unless he checked with the trolls first, and he did not do that. So shame on all three of those guys. And somebody actually sent an email in that was directed to Michael saying, Michael, don't unpack your suitcase because you won't be there long at Revere because of the toxic work environment. Michael, have you unpacked your suitcase yet? Are you feeling okay?
Yeah. So while we're on that topic, I'll take this time to say I couldn't be happier with the position and the job. Honestly, it's really a dream job for me in an industry I love, and not only that, I mean, typically Wall Street is a fairly toxic environment, and working in finance and investing is a very cutthroat, not um, they don't really care about your feelings. Let's say that. And at Revere, I couldn't be happier. And not only me saying that, I spoke to Hunter and Alex before I started the job just to see what their thoughts were before I decided to unpack my bags, and they said it's an amazing place to be, and I couldn't agree more. So I've not only unpacked, I found a new place to take my talents and live. So I've unpacked and found a new home even. So
Very good,
very
Michael. That
happy.
bonus that we discussed, if you nailed that segment, will be in your next check. Nice job.
Thank you, sir.
Ted, I know you checked us out, and I'm sure Richard, after my interview, told you what a toxic work environment we have here, and yet you took the job anyway. What were you thinking?
I don't know, man. I guess I like the toxic work
Get that
environment.
smile
But
off your
anyways,
face right now, Ted. This is a
anyways,
toxic work environment. Didn't you get the memo?
yeah, Richard and Ross only had good things to say. I also talked to George on the phone as well. He said he was friends with you, and he
Yeah,
recommended checking out Revere, checking out
George and
Don.
I,
So I reached out to
George and
Don,
I,
and
10 years ago, George and I were at uh, in Chicago. I think he's from Chicago, is he? Anyway, I think we were in Chicago at a Investors Business Daily, one of the advanced seminars that they had, and we were walking down the streets and
okay.
talking about how we wanted to start investment advisor businesses someday. And look at us, here we are, it worked. So other things that the trolls have said, we got a nice email about somebody explaining to us how we should properly establish our management and levels of hierarchy by immediately bringing on two experienced portfolio managers, because those guys grow on trees and don't demand any compensation. So we're going to get right on that, Mr. Troll. Thanks for chiming in. You obviously know better than we do. And then my favorite one is, because we're so transparent, the people that decide to criticize some of the trades that we make, because I suppose we should be batting 1,000 and never be wrong, but that's not really realistic. And um, our results speak for themselves. We got our clients out of the way in Q4 of 2018. We got them out of the way in COVID. We got them out of the way this year. and our overall returns, anybody that's in protection for 5 years is beating the indexes across all time frames. So with less risk because of how we raise cash during these downtrends. So I guess we're doing okay with our with the market down 23% and our assets being near all-time highs. But hey, trolls, keep it coming. We really enjoy it. It gives us something to talk about on the show. I think it was probably a somewhat entertaining segment, and we'll just go ahead and leave it there. Okay, number 2, Zach, was case law relative to protecting your client's assets. Are you ready for this one?
Did you say a Levee versus Bessemer? Is that what I heard?
Yeah, Levee
Okay.
versus Bessemer Trust. And what kicked this off of me is somebody sent me on Twitter. Somebody sent me an article where somebody wrote into Market Watch and said, "Hey, I told my advisor that I was retiring at the end of this year, and they didn't do anything to my portfolio, and now I've lost $100,000. Can I sue them?" And I don't necessarily agree with the response of the person from Market Watch that replied to them because they're certainly not familiar with this case law. But there's a guy on Twitter I follow. His handle is @InvestSense. And what he does, he used to be in compliance for a brokerage firm. And now what he does is he reviews 401k plans on behalf of the participants to make sure that the companies are not charging excessive fees and are providing optimal options for the 401k participants. Because I think we all know, we've heard horror stories about high fees. The industry has done a pretty good job of cleaning up 401ks. They used to kind of be used as the owners of the companies didn't particularly care that the fees were high and that they were getting taken, the employees were getting overcharged. But the industry has cleaned that up a lot anyway. But this gentleman chimed in on a discussion I was having with a buy and hold pie chart advisor about never having any sell this, never protecting his client's downside. So James InvestSense sent us all links to this Levee versus Bessemer Trust, which was basically the plaintiff sued. And Bessemer Trust is a huge asset management company. They manage billions of dollars. But the guy was worried about the potential loss in his portfolio. He had concentration in one stock, and they just ignored it. He lost a bunch of money when that stock went down. Then he started talking to some other people, and they said, well, they could have hedged that. And when he realized that that was even an option, he presented it to Bessemer, and they didn't seem to care anyway. And the bottom line is that the judge sided with the guy who sued them, and his takeaway from this is that quote, "The takeaway from Levee is that advisors simply cannot stand by and watch investors suffer significant losses, and then blame it on the market. Levee and other similar decisions," so this is not the only case, but this is the only one I'm citing, "have established that investment advisors and other investment fiduciaries have, at a minimum, a legal duty to advise a client of hedging strategies, positive and negative aspects of the same, and then let the client decide on whether or not they want to use them." So basically, case law is on the side of Revere Asset Management as far as taking active downside protection, risk management procedures to minimize losses in severe bear markets, which is really our calling card. That's how we differentiate ourselves from the buy and hold pie chart guys. That and waiting for the market to be right and leading stocks to set up and start acting correctly. So the bottom line is that we focus on what the market is actually doing and whether it's healthy or whether it's risky. And every night, that's why every night in the video I go over this chart right now, if you want to show it, Zach. Anybody that might be new to this, basically what I say every night in the video, we track over 3 time frames. The green line is a short-term time frame. That's a 21-day moving average exponential, which means it's the sum of the closes of the last 21 days with more weight given to the more recent close. The red line is the 50-day simple moving average. That's just the last 50 closes all added up and divided by 50 and plotted on the chart. And the long term is the black line. That's the 200-day moving average, which is the last 200 days added up, divided by 200, and plotted on the chart. And as long as the trend is above those three moving averages, we are as invested in the market as we're comfortable being for our clients. Now, if they start to roll over, go sideways, or break below those moving averages, and the slope of those lines start to roll over, we're going to really start selling things, and the market will take us out. The market will our stops will get hit. There will be a reduction in the number of good opportunities to get into, and the market basically tells us what to do. We let it make the decision for us. And then if we break below this black line, that's the long-term 200-day moving average. That's where risk is by far at its highest. And I think everybody is familiar with the chart that I show all the time. This is the last 13 bear markets. We're actually right here, and we're threatening to break below the July lows. We came within like 40 points of them today, I think. So if we go lower than this, and basically this is saying if you lose 24.5%, you got to make 32% to get back to even. If it's a severe bear market, the average of the last six, it was a loss of 44.5%. You got to make 80% to get back to even. So if you started with $1 million, you went through this severe bear market, you're heading into retirement, all of a sudden you've got you've got $560,000 instead of the million that you thought you were going to retire with, and you got to make an 80% return on that to get back to $1 million. You can't do that if you're how long you have no idea if or how long that's going to take you, and that's why we take defensive action for our clients. It's a common sense approach. There's no other aspect of your life where things start going south when that you don't take corrective action. And I always like to use the two examples. If the service engine soon light comes on in your car, do you just ignore it? No, you don't. You take it in. If you're going out for the day and there's rain in the forecast and you take an umbrella or not? And if you don't, you're going to get rained on and get wet. But yeah, I'll dry eventually. Sure, you will. But you're going to take corrective action. You're going to prevent the worst thing that can happen. And if you're market technicians the way we are at Revere, you can distinguish a healthy market from a risky market. And right now, we're in an extremely risky market, downtrending under all of the moving averages, and the averages themselves, the slope of the line is in a downtrend. So this is as risky as it gets. We got stopped out this week. We're either in 100% cash, or for clients that had some legacy positions with unrealized gains that they didn't want to pay tax on, we've hedged those positions. And that's going to be a nice segue into Ted's segment when we get there. But anyway, Levee versus Bessemer Trust. The case law is on our side, and if you're approaching retirement and your advisor's not doing anything for you, ask them why, and then tell them, okay, you guys maybe should look up Levee versus Bessemer Trust, or you could just call Revere. That's an even simpler solution to the approach. So Levee versus Bessemer Trust. So what does that tell you, Zach? How do you feel about that?
Yeah, I feel pretty good about it. Still a little confused, but I'm a man on the street. I'm prone to being confused. What do you think?
Prone to being confused is the man on the street. Well, Jesse Watt. You remind me of Jesse Waters, the man on the street. This is Zach's world. This is Zach's world, and
we're all just living in it.
And we're all just living in it.
That's right.
Okay. Yeah. All right. So anyway, this guy that I have been engaging on Twitter about not protecting his downside, he's called me a snake oil salesman.
Wow.
He's called me a charlatan. He suggested that I use tarot cards to make better decisions for our clients. He likened it to being about as accurate as astrology by trying to by trying to do risk management. And finally, he said anybody that's a client of Revere is either dumb or dumber. So we're probably not going to change this guy's mind, but maybe his clients bringing up Levee versus Bessemer Trust to him might change his mind, because both Tim and I have talked repeatedly on here about the terrible experiences that his parents had, and that my father-in-law had when he was dying in cancer back during the bursting of the tech bubble, and he was with Morgan Stanley, and they did absolutely nothing to protect him. And his widow ended up getting half of his nest egg because the other half was frittered away while they did absolutely nothing. So this is personal to us here at Revere. Um, a lot of times I think that I get more upset than the people that are actually losing the money do. But I guess that's because I just know and I'm convinced that this is a better approach. And of course, the reminder that Danny and I, the partners in the firm, have all of our retirement and family's money in the same strategy that we use for clients. So we put our money where our mouth is. And that's going to wrap up that segment. So Danny quote check, Rolls check, Levee versus Bessemer check. Next up is the have at it client. This is somebody again that was at uh, a big brokerage house, and the stock in particular that was really the straw that broke the camel's back for them. So they came across Revere Asset Management, and they had this big bad broker sell a bunch of stocks to raise a certain percentage of money that they transferred over to Revere, right? So they saw for about a month what we did, how we've been watching our videos, and their account balance kept going down along with this market. So they decided to have another meeting with the director at the branch, and they said, why don't you sell? What's your sell discipline? They said, we sell based on fundamentals. And they said, okay, well, let me ask you a question about this stock that you have for me, Scott Miracle Grow. I once had 50% gains in it. If you can show the chart on this, Zach. So Scott's Miracle Grow. This chart, they said, she said to the guy, I once had 50% gains in this, and now I'm down 50%. What is your plan for selling or getting out of this position? And the guy was just silent on the other end. And she said, I think I know my answer to this. And the guy said, well, if you think you can do a better job than us, then have at it. And that was it for her. She's now a fully fledged client at Revere Asset as of this morning. But as a nice parting shot by her broker to her, she asked us to review her holdings before it came over. She had 94 separate positions, 94 stocks. So basically, they put her in her own little mutual fund. You can't watch 94 stocks. Nobody can. We concentrate in just the best of the best. So I sent her an email and I said, you should sell these 37 right away. You can harvest some losses and then bring the rest over, and we'll address what's left, and we'll start hedging and selling what's left. So she sent the email over to them, didn't hear back for 2 days. They didn't sell them. In the meantime, the transfer started to go through. So by the time they decided to act on it, they emailed her and said, it's too late. The transfer's happened and we can't sell any of those. So do you know what the market's done over the last couple of days, Zach? It's done basically straight down. So they've cost her an additional thousands of dollars because they didn't care enough to act on the wishes of the client. So that's the latest horror story of clients that, no matter how big they are, or firms that are so big that they don't really particularly care in their approach or for protecting the downside. So those are the 4 segments that I covered at the beginning of this, and we're going to segue now to Michael, who is going to enlighten us on fertilizer. Take it away, Michael.
Okay. All right. So
we want to point out Michael's shirt. If you haven't seen Michael's shirt, we love that shirt. It's ARK Invest, ARKK. Our closest tie to ARKK has been to short it using SARK, which is an inverse ARK ETF. And Michael, every time he thinks about what he's doing, every trade he's going to make, he looks down at his shirt and makes sure that it's not something that Kathy Woods would do, because she's given back basically all of her gains during the recent bull market by, again, not having a sell strategy. So now I'll shut up. Take it away, Michael.
Yeah, it's just it's a beautiful reminder to manage risk. In a couple podcasts ago, I showed that little card that I have at my desk. I don't have it with me today because I'm on the road. So basically, this is that reminder. It serves the same function. It's
that reminds me, we got a troll email about that too, Michael.
Did we really?
Oh, really?
Some guy did not like that you you do that. I have my offices all over the place. I have little sayings and cards and stickers and stuff to remind me to do. One of the best O'Neill type traders forever, Jim Ropel, has big signs on the top of his monitors telling him what to do and what not to do. But a troll said that he didn't like the fact that you had a card with some important points on it next to him. So yeah, Zach, these are the types of things that we get from, Tim used to say to our clients, we love you all. There's some we don't love. Let's be honest.
It's almost like these folks are afraid of change and risk, and I'm not, really sure why, because those are all reasonable things to deal with in this industry.
Well, Zach, unreasonable people do not deal with reasonable situations. So,
yeah, indeed.
Michael, I'm sorry, I've interrupted you twice now, but I will not interrupt you again.
You promise?
Because I'm creating a toxic work environment by doing that.
Yeah. So yeah, I guess today it's not PC to call yourself a loser. I'm sorry that I offended anyone by writing that card. But and it's not even an original idea of mine. I read it in a book, and I think Mark Minervini actually has the same card, and I think he tells himself that in the mirror every day. He said when he wakes up, he goes to the mirror and tells himself that he's a loser and he can do serious financial damage to his account. So I didn't come up with it, but I use it and it works. So I apologize for those that are looking out for me and my feelings. So I'm sorry if I offended you. So now going into the segment, I wanted to talk about fertilizers, and this is the issue where the fundamental approach doesn't always work because the fundamentals are still in play, but the stocks now aren't responding as they should because perhaps and this is where it's difficult to tell, and a fundamental approach can't lead you to the prize necessarily because it's very possible that a lot of this has been priced in, and now those that got in early and insiders are taking profits on these positions. But fertilizer, there's a big shortage of fertilizer globally, and there's also a shortage of crops. And a big problem with fertilizer is that natural gas is used as a feedstock to produce nitrogen fertilizer. Natural gas represents the largest source of energy for nitrogen fertilizer as well as Canadian potash. So the issue is that globally, if you've seen, as we spoke about a few podcasts ago, the prices of natural gas globally and especially in Europe are astronomical. So a lot of fertilizer producers in Europe have already said that the input costs are too high and it's just not feasible for them to continue producing fertilizers at these prices. So they've actually stopped production. They've halted production. And in the U.S., because and in North America in general, because Canada has access a lot easier to these natural gas prices as well, the North American producers that can produce this fertilizer with such a lower cost input are should significantly benefit from this. And a big problem too is that as I'm sure a lot of you know, but if you don't, Russia and Ukraine export 30% of global wheat, and they're 20% of the global corn trade. So if Russian and Ukrainian exports continue to stay cut off, the world is going to lose 30% of that wheat because it's very difficult to store grains. They expire. There's issues with pests and rodents, and it's not like gas that you can just store or oil that you can store in barrels. It's perishable. So that's a big problem. And then also going forward is even if this war ends and there's a solution, there's a big in Ukraine that that they're not expected to plant a normal crop next year due to the damages of fuel depots, infrastructure, farming equipment, and the dislocation of people. So it's going to take a while for that supply to come back onto the market. So what do you do in that case? You start growing in other places, and they need fertilizer to do that. So in essence, the thesis here is that whoever has the lowest input costs will benefit, and the North American producers have access to some of the cheapest natural gas in the world. So two companies that have been performing well, they were leaders in the market, they were holding up super well. Our first is CF, which is an American company based in Illinois, I believe. So if you could pull that chart up, Don.
Yep.
Yeah. So CF, it had a great run. It started its run early or late in 2020, but the problem is that it was up 3.5 times. So it's not a new story. The market definitely was pricing that in, and it exploded from that first base breakout in December. So it is possible that it continues to do well. The fundamentals are supportive, but now it's just a matter of getting in at the right time. I started a position actually a few days ago as it was holding the 50-day moving average, and then as soon as it broke that, I actually sold it this morning. It was a 2.5% position. I got stopped out. Trade didn't work, so now just a matter of waiting for it to set up. So yeah, if it can get back above those key moving averages and hold, then it could be an opportunity again. But for now, it's done. It's out of my portfolio. And then another one is NTR Nutrien, which is a Canadian company that also very similar chart, was holding up super well during the first stages of this bear market, but same thing. It's now broken below key moving averages, so it's done for now. But that one ran up 3x from its initial breakout in December. So that's the issue with only a fundamental approach. I'm sure most of the pie chart investors, if they did have a position in this, the fundamentals are still supportive. You can see the sales and earnings growth. Last quarter, sales were up 49%, earnings up 181%. Estimates for this year are up 164%. So in terms of the fundamentals, there's no slowdown in sight, but the technicals are breaking down. And in a bear market, unfortunately, they can take everything down. And correlations, as Don said, go to 1, and a trout can't swim up a waterfall. So you've got to let them go and wait for them to set up again if they do, and sometimes they don't, and you're glad you got out. So yeah, the fundamental case for fertilizer still exists.
I want to point out on this
Yep.
chart very quickly, Michael. Look, this black line here, and this is why MarketSmith is so good. It gives you so many things that you can reference. This black line is the S&P 500. Okay, so then you can compare what the S&P 500 was doing versus the underlying stock that you're looking at. And then you can also gauge the relative strength of the underlying stock versus what the rest of the market is doing. And between those three lines, you can draw a lot of conclusions. You can see where we started. These stocks were very high on our list. They were on the 21 over 21, and we were discussing them in-house during this period right here where they broke out while the market was correct. See the black line going down, so the S&P is going down. Nutrien is acting fantastic, and you can see the slope of the relative strength line. But it stopped, plain and simple. So the thesis is good. The numbers are good. The market was just too much for it, and in a down market, stocks eventually, 75% of them will do what the market's doing. So the market kept going down. Nutrien stopped going up. It rolled over along with the markets. And although this is a bad chart, if you look at the price action, when you consider what the S&P is doing, all of it's doing is what the S&P is doing, because you can see that by the relative strength line going sideways anyway. And these are the types of little nuances that we look for in charts, and why MarketSmith is so helpful, helping us draw conclusions and narrow our watch list. So
Yeah.
Go ahead, Michael. Are you going to talk about Mosaic?
Mosaic is it was a weaker one in the group, so we can talk about it. But I think CF was definitely the standout name. And if you pull up CF, what's interesting about it is that is this Mosaic? Yeah, just I'll just talk about
Yeah.
CF one more time quickly. So CF actually during that consolidation period where the market was pulling back, CF actually broke out and hit a new all-time
Yep.
high. When the market pulled back in late August and started to sell off again, CF was the strongest name, and it was like one of I think one of very few stocks that were up during that sharp decline after I think it was the Jackson Hole speech that the market tanked, and CF was actually positive on that day. But after hitting that all time high, it failed that breakout, pulled back. It looked like it was holding that 50-day on high volume, so that's where I got involved on that undercut and reverse, and then it broke and it just couldn't handle the weight of the market. So
Yeah, here's
even
the
good
day that you're
names
talking about.
can go down.
826 was that Jackson Hole day, and you can see, like you said, it
Yeah,
finished positive and at new highs, while the market had a very negative day that day. And you're absolutely right about
yeah.
Mosaic being the laggard. You can see here how it's broken below the 200-day moving average, which is much worse on a relative basis versus NTR and CF. Anything
Yeah, I
else on
liked
these?
CF because it was. Yeah, I liked CF the most. It was the strongest. It had broken out to a new high, while these had kind of lagged within their bases. But yeah, I mean, for now, it's interesting. There's a lot of oil bulls as well. You would think that oil would be going higher, but if you pull up XOP or XLE, those charts have broken down as well, and it's the fundamentals in this case don't really matter. It's just it's the charts, so you can sit in here and continue to hold these stocks and these ETFs because the fundamentals are so strong, and there's war and cutting off Russia. But I mean, look where XOP is now. It's back to where it was exactly a year ago in September. So before this war even happened, we're back now to those prices.
Yeah, what a day for oils today.
So
XOP down 8.5%, OIH down 9.5%, XLE down 7%. Unbelievable. Today was the
yeah,
day that they came for the last group that was showing any relative strength, and that's energy.
and that's why self discipline is important. When it doesn't work, you got to get out.
Absolutely. Is that it?
Yeah, that's all for me.
Excellent. Ted, inverse single stock
Yep.
ETFs.
Yep.
New concept. We talked about
Yeah.
this week, and let's get to it. Tell us what you
Yeah.
got.
So single stock ETFs are what you said earlier on in the podcast. They mirror the action of a particular underlying stock. For example, we have AAPD, and that essentially mirrors the action of Apple. And if you were to go short, you would long AAPD. And so recently, Direxion and AXS Investments came out with these single stock ETFs, and they're particularly useful because for people that don't want to play options and leverage that way, we can take these inverse ETFs to short these particular stocks, which we didn't have the capability to do before. Um, so yeah, at Revere, again, like Don has preached many times in his daily market videos and on this podcast, we focus on preserving capital during downtrends, and these ETFs can really help us either hedge our positions or go net short. And so right now, Don has pulled up. Is that the Apple chart?
Yeah, we got Apple on the
Okay, yeah,
left and
yeah,
AAPD, the single
okay,
bear
yeah,
Apple ETF on the right.
okay, yeah. So clearly, you can see the difference between these two charts. Apple pretty weak action under the 200-day, under the 50-day. And what we would like to see is potentially like Apple rallies into an area of resistance. And it would be even better to have that area of resistance with confluence with some key moving averages like the 21-day or the 50-day. If you look at the chart right now, the 50-day and the 200-day are pretty much overlapping. So if Apple were to rally to that area, it'd be a pretty low risk entry point to get in some AAPD and essentially short Apple. You also have
And
Tesla, Amazon,
we're
pretty much all
actually
the
we're
mega
actually
caps.
sorry to interrupt. We're actually doing this for a couple of clients right now that have unrealized gains in Apple. And in the past, before these came out, we would have to either use options, which aren't a perfect hedge, or maybe the QQQ, which is not necessarily a perfect hedge either. But with these one-to-one offsets, um, you can see, like as Ted mentioned, rallying into a resistance area. Here's 2 days when Apple came off the bottom right into the declining 21 and it failed there. Right on the other side, you see AAPD pulling back perfectly to the 21. So the charts should look mirror images of each other, one getting support at the 21, the other one seeing resistance at the 21. But you always want to use the chart of the underlying to make your decisions, because anytime you're using a derivative, there's room for a little bit of tracking error. You want to make your decision on the underlying, which in this case is Apple. So you see Apple failing into a moving average, a declining moving average. It's nice that it corresponds to what AAPD is doing. But for example, I use SSO and SDS, which are 2 times long or 2 times short S&P 500, but I never even look at their charts. I always just look at the chart of the S&P 500 to make my decisions.
Mm-hmm.
And
So
And
can I
something
quickly
else
just
to add.
mention?
Oh,
Sorry,
Michael.
go
can I
ahead,
just
Michael.
mention one thing?
Yeah.
What's cool about these inverse ETFs as well is that so when you're shorting a stock, you need a margin account because there's unlimited risk to the downside. If a stock rallies 200%, you're going to lose 200% of your position. So there's an unlimited downside risk when you're shorting. But with these inverse ETFs, you don't need a margin account to do it. You can do it in a 401k or an IRA, and the most you can lose is, and obviously you're not going to hold it, but in the worst case scenario, the most you could lose is the amount you put in. You don't have unlimited risk in an inverse ETF, so it is helpful in that way as well.
Yeah, that's a great point. Don,
Tesla
what are your
and
thoughts? Oh,
TSL.
sorry.
Go ahead.
Yeah. So another point I wanted to bring up was, although we don't predict at Revere, we follow the current action of markets. Do you think that Direxion and AXS bring out these inverse ETFs could potentially like just show the complete bearish sentiment we have in the markets and the demand that people want to short these stocks that have already been beat
Well,
down 30
it's
to
very
40%?
possible. It's very possible, but I'm going to take the opposite tack. I'm going to say that this is a tool that advisors maybe cannot were not able to use before that they can use now. Uh, I'm not as big a fan as of the like 1.5 times bull that they have, like, which means
Yeah.
Tesla can there's an ETF for 1.5 times whatever Tesla's doing. We wouldn't use that. There's higher fees involved in it. We just buy 1.5
Okay.
times whatever we had in Tesla. I guess if you're limited to the size of your account, that would be beneficial, but I wouldn't think that would catch on as much as the inverse ones do, because you can
Yeah.
use them for hedging and use them, as Michael said, in retirement accounts to make money in a downtrending market.
Yeah.
Ultimately, they'll be judged by their popularity. There are a lot of ETFs that get started. They sound like a great idea, and they end up closing shop within a year because nobody uses them.
Yeah. These definitely are quite useful, at least in first glance.
Yeah, you can see the volume on this one. This TSLQ trades 1.2 million shares a day already, so it is getting used.
Yep. Over that
Yeah, I guess the
4308.
biggest risk. The biggest risk to these single stock ETFs, like if you're doing it in Apple or Tesla or a big name, it's fine. But the ones, if they start making them for smaller, less liquid stocks, if any of them get bought out or they significantly gap up, I mean, most of them will just go to zero because of that percentage change. But a big one like Apple or Tesla to use as a hedge makes a lot of sense.
So what other ones you want to look at, Ted?
We have Amazon, pretty much all 6 of the mega caps. So Amazon we could look at next, and then we can go to Google, Microsoft, and Nvidia.
What's the ticker for the Amazon?
It is
Short.
AMZD.
Yeah,
And
see,
so
this one's not
you,
liquid
you
at
just see
all.
that thing. It's just flying. Yeah.
Right. But only trading 10,000 shares a day, and you can see
Yeah.
by the gaps.
Yeah.
If it's thin like this, you better use a limit order to get in to make sure that they don't jack the price up on you.
Yeah. Yeah.
Google,
And
what
then
was
GGLS.
GGLS? Usually,
GGLS.
they're ending in
GGLS.
D for down or S for short
Yeah.
at the end.
Google is
Here's the
pretty
Google short again.
even
This
less
one's only
liquid.
trading 1,800. Yeah,
Yeah.
1,800 shares a day, so not much liquidity there.
It's fairly new, so most people probably don't even
Right.
know about these yet.
Yeah, Tesla's really caught on. AppD, which is what we're using, like 50,000 shares a day. This is trading, but we put limit orders in, and we've got filled. I've been tracking it. I've got them right next to each other on my monitor, and the price up, the price down for Apple is very close to the price up all the time from a bid and ask perspective. So you would get filled in a pretty good position if you're trying to offset something 1-to-1.
Yeah. And then Microsoft MSFD.
Yeah, liquidity definitely being a problem with
well.
these, as you can see.
Yeah.
Right.
Yep.
Do you know if these ETFs though are they open end? Because if they are open end, then the liquidity is it's like the way that they do it and track it. It should if they can just offer unlimited shares, it shouldn't really affect the like liquidity. If they're just tracking 1-to-1, then liquidity shouldn't be an issue. It may just be a matter of interest in the market and a matter of investors not knowing about it, but I'm not sure. Yeah, because so that'd be something
Yeah,
to look at.
these gaps in the chart are what would give me pause on buying something this illiquid. But I think Tesla is really probably the leader from as far as what's catching on and what's not catching on. I think that's the only one that actually has two, that both of these firms have both put out a Tesla one. I think that each of the other ones only have one. Yeah, here's a Tesla short. So you've got the Direction one, and you've got the AXS one too. AXS, they must have got theirs out first because TSLQ is by far the most liquid.
Definitely.
So any other insight on these, Ted, that we should know about?
I currently don't have anything else. I think the most important thing is that you can use these to hedge, or you can use them to just short these individual stocks, these mega caps.
It's going to be interesting to see if they catch on like that. I think it would probably take one of the bigger firms that put these out. Direction is I hadn't heard of AXS before. Direction is one of the bigger ones that it has come up with unique ways of generating ETFs. Some of them catch on, some of them don't catch on. Every once in a while, we get emails. Dan and I get emails from people that work for the firms wondering if we're interested in something like this. There have been a couple that have caught our eye. In fact, some things that have been recently a really good hedge for the market. Commodity CTAs, commodity tracking CTAs. There is a trend. It's trend following, basically, is what it is. It's named after commodities because that's where the system was developed. But there's 3 of them that have acted as a perfect hedge, and basically, this is pure trend following. If you break below the 200-day moving average, they're going short. If you break above the 200-day moving average, they're going long. They follow a strict set of rules, but the 3 of them that I'm monitoring are, one is ticker CTA, in fact. Managed futures is what they call the strategy, and CTA is the overall term for the people that are known to have used these in the institution. So CTA is one. You can see that's up on the day while the markets are taking a beating. In fact, they've all been positive over this last little run. KMLM is another one. Managed Futures by KFA Mount Lucas. Managed Future Strategy. You can see that's breaking out of a nice cup and handle today. And the third one, and these have varying liquidity. So if you were going to use it, you would need to use a limit order. DBMF is the most popular one that I've seen that trades 460,000 shares a day. And you see that breaking out on a nice cut base also, doing really just the opposite of what the indexes are doing. So these are similar to inverse ETFs, but they're a pretty good hedge versus a bearish market. And then on the other hand, if the market gets bullish, they know when to turn is basically what it is. They don't wait for different signals. And this is something that we're doing some research on in-house about a possible way to smooth volatility in our overall portfolios. So I think that's everything that we had on the agenda today. Michael, you got any parting words for our esteemed audience?
No, I just hope everyone's doing all right and was prepared for this. Yeah, I mean, it's been a pleasure learning from Don and working with Revere and being able to avoid these potentially catastrophic events to your portfolio. So yeah, I just hope and especially those close to retirement that are with these pie chart investors that have no sell discipline. I just hope they're not being too hurt by this.
Yeah.
So
one of the big negatives of these pie charts this year has been the bond market doing something that it doesn't usually do. Bonds at an institutional level have always been used as a hedge. In the prevailing wisdom behind the 60-40 portfolio was that the bonds should either soften the blow or go up while stocks are going down. This is a chart of the Vanguard Total Bond Market Index. That looks like the S&P 500. It's been going down all year. So this is the illusion of diversification that you get by diversifying into a downtrending asset class. And we have robo strategies in house here that we use that you just avoid them. I like to say it's the equivalent of trying to maintain a well-balanced diet, but you're eating rotten vegetables to get your vegetable fix in the food pyramid. That doesn't make any sense. So we don't diversify into downtrending asset classes at Revere. It's just, in fact, we get out of the way of anything that's going down because that implies that the trend is down and we're trend followers. So even though it's snake oil, we're charlatans, and what else did I say? We use tarot cards.
Yeah, reading the tea
and
leaves.
Astrology.
Yeah,
tea leaves. Yeah, astrology. Yeah. So that's us here at Revere. So, Zach, what are your parting words as our man on the street?
I think it was a great show. Looking forward to Danny being back next week.
Well, I guess we'll wrap it up then. I don't think I really need to go into a whole lot of detail. The 21 over 21 list has been devastated this week. As of last night, there were only 4 stocks remaining that were above their 21. Let's take a look at the 4 and see where they are today. First Solar, breaking the 21, just below it today.
Mm-hmm.
Northrop Grumman, this one got a pop this week when Putin started acting like a madman again, but you can see that lasted for 2 days, and now Northrop Grumman has broke below the 21. LNG, which we owned for a while. We all know the story, but when the fundamentals don't match the price action, you can't stick with the fundamentals. One of our rules is buy on technicals and fundamentals, but sell only on the technicals. You can see that LNG has broken the 21. And the last stock was CEG, an alternative energy stock, also breaking below the 21. So 21 out of 21 of the 21 have broken below their 21. That tells you all you need to know about the market, and that's why last night we went to bearish / downtrend on our trend gauge for the leaders. That was the last holdout with all the indexes being in a downtrend. So, folks, if you like what you heard, tell your friends, tell your family, go to revereasset.com, and we'll see you next week on Your Money. Because remember, it's not how much you make, it's how much you keep.